cost of capital. In this case, we're going to talk about the different types of sources of where you get your funds and the different costs related to each one of those sources of funds. So with a corporation, they have three fundamental sources of funds. Earnings, which comes from their profits, which because the profits are owned by the common shareholders, that is cost of equity, which is something you would have taken in chapter number 10. Another source of funds is they can go out and borrow the money. So a loan, which is cost of debt. In the third source of funds is the company has, or the corporation has, source of funds where they can issue shares. Now they have two types of shares, common shares and preferred shares. There can be different costs of each. So KP and KE, or if it's brand new, it's called KN, which is for new, from also chapter number 10. And we're going to do some review from chapter 10 into chapter 11. So as I was mentioning, corporation has debt, which is the same as what you and I have. If you're a student and you have a student loan or a line of credit, be the same thing. Now a corporation gets to charge the interest expense for debt as on their income statement, so it's reduced by the tax rate. They have the cost of preferred shares, KP. There's no taxes or effect on dividends for preferred stock, and the same for common equity. So the earnings after tax and or the cost of new shares are the three sources. So you have debt, preferred, and equity, which can be from earnings or slightly different if it's issuing new common shares. You can see that you've got the weights, and a lot of effort is put into this, determining the weights. That's in actually an advanced finance course where you determine the rates. Cost of debt, preferred, and equity is something we've either gone over or will go over. You simply take the weight, multiply it by the cost, and sum it up. So you can see that this company's cost of capital, KA, is 10.26%. And what do you use that for? Use it as your interest rate when you discount cash flows. Now, cost of debt. As I mentioned a moment ago, cost of debt you get to take taxes off. So you take the yield rate, which is Y, you subtract 1 minus the tax rate, and you get cost of debt. Now, if it's for new debt, there will often be a flotation cost. You can't just go and issue $800 million worth of bonds and there's no cost. You have to develop a prospectus, which basically tells people what are you going to do with $800 million. You have lawyers, you have fees. Issuing debt is not free. If you go to the bank and get a mortgage, there are fees for issuing the mortgage. There's liens that have to be registered, and you, as the consumer or customer, have to pay for those fees. So in this particular case, it simply shows you the calculation. It shows you that the current yield before taxes is 10.74. The tax rate is 39%. So the company actually only pays 61% of the cost of debt. So it's actually considered normally fairly cheap compared to issuing preferred or common shares. So debt is a preferred way of doing things because it's the only one of the three that has the tax reduction, in this case by 39%. There are 3% float costs, which increase the cost of issuing debt, and your final answer is 6.75. Now, we did KP in chapter number 10, so this is just a review of the formulas. The one addition, as you can see, is a denominator rather than just the dividend divided by the price. You also have 1 minus the float cost if it's given as a percentage, or if it's given as a dollar amount, you would take the purchase price and subtract the flotation costs if they're in dollars. So the top one is in percentage, and the bottom one at the very bottom of the screen is in dollars. So you can see here's again the formula. All right. So, and again, we did this in chapter number 10, except the new thing that's been added is the fact that we have a flotation cost. Like I said, flotation costs can be underwriting costs, the cost for issuing the loans. There's a whole long list, but bottom line is it costs you 4% in this case. In this case, if yeah, it could be even brokerage fees. Long list of possibilities, and the detail of possibilities doesn't matter. What matters is you don't get dollar for dollar. You only get 96 cents on the dollar. Or in this case, if there's $100, you only get $96 out of that. Equity, we took this in chapter number 10 for calculating the cost of equity. So the same formula you did in your assignments from chapter number 10. So this is nothing new. Just another example of the calculation. Now, so same thing with retained earnings, because the retained earnings belong to the common shareholders. So it's KE. Now, as I mentioned a moment ago, if you issue new shares, again, the stockbroker is not going to sell your shares for free, and you definitely need to develop what's called a prospectus. And the simplest way to understand a prospectus is if a company, and the Royal Bank did this a few years ago, they issued shares and they wanted $200 million. Now, the people lending the $200 million were kind of like, want the question answered, what are you going to do with the $200 million? Why do you need the $200 million? Just think about this. If a friend of yours asked for $500, do you not somewhat get the right of saying, like, what are you going to use the money for? Is that not a fair question to ask? And certainly if you're viewing it as an investment. A number of years ago, a friend of mine lent me some money, and with the understanding, okay, what are you going to do with the money? All right. So it's the same kind of thing. So that's all a prospectus is. It says, I'm going to borrow the money, in this case through by issuing new common stock, and I have to develop and say what I'm going to do with it. So that flotation cost is the same as before. So you can see in all three, you could take the formula we had from chapter 10 and divide it by 1 minus the flotation cost as a percentage. So again, here's the calculations to show you that they wind up to be the same thing. In this case, there's a 10% flotation cost, or $4 a share because you issue the share for $40, but you actually only get 36. So you wind up with the same 13.33%. And that's the end of chapter number 11. Typically, as a summary of this, cost of debt will be the cheapest. Cost of preferred shares will be the second most expensive form of financing, and the most expensive form of financing will be KE, which is cost of new equity or cost of equity.